thinking Yahoo.
Yeah, Paul, dodge all the way.
Yes, ma'am.
Alrighty. So we are live on YouTube now.
Beautiful.
I'm interested to see what they have in the monetary policy report. So I know the press conference is going to start in a couple of minutes here.
Yeah, where can I find that?
You go into Forex Factory
Oh,
and then click the folder next to FOMC. No, just go into, the calendar. The folder next to FOMC statement. And
okay.
then click on latest release.
Right here?
Yep.
Oh, nice.
And then when you scroll down, just look for your date, which is going to be March 15, 16, and then PDF. No, right there. Yep.
So statement or projection?
So that's the projection, but right next to that is the statement.
And which one do you want up?
I want to look at the statement.
Okay. Where are we?
So, just go back and then statement. There you go.
Awesome.
So they talk about the war here too. Look at the second paragraph.
Yep. The invasion of Ukraine and Russia is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. So you can already get a sense of where they're going with this.
Yep.
Committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. The appropriate filming in the stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. In support of these goals, the committee decided to raise the target rate of the federal funds to quarter to 0.5% and anticipates the ongoing increases in the target range will be appropriate. In addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at the coming meeting. When is the next meeting? Are they talking about April?
Yep.
Okay. According to the monetary policy. Okay. Yeah.
No, May 3rd and 4th.
Okay. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that can impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings of public health, labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. Voting for the monetary policy action were Jerome Powell and all these people, the Fed members. Voting against this action was James Bullard, who's always been kind of dovish, no? Actually, no, he's been
Hawkish.
kind
Right? I think
What's that?
I think he was more hawkish, no?
That's what I thought. I thought he was the one more hawkish than.
Yeah.
That's what I meant to say. That's a little interesting. Who preferred at this meeting to raise the target? Oh, okay. So he wanted the 50 basis point increase. Okay.
So essentially, if you go and you read the Forex Factory and you look at the data points, so basically we didn't increase from like 0 to automatically 0.5%. What that number tells you, can you go into Forex Factory real quick just so I can explain like how to read it?
Yeah. Sure.
I think, yeah. So right there. So this does not mean that we increased to 0.5%. That's a range. That's how, this is the entire range. So what you had on the first one here was 0 to 0.5%. So, when you look into interest rates and how, they're used and between banks and all that type of stuff. So if I'm a bank, and let's say Stefanos is a bank, and I'm trying to get money from him, right, just like borrow money for whatever reason, so now he can give me an overnight rate of anything between 0% to 0.25%. that rate hike that we had, this is still a quarter basis point hike. It's not a 50 basis point hike. If it was a 50 basis point hike, then this would have said 0.75%. So now what he can do is give me a loan and, charge me like anything between 0 to 0.5%. You guys get what I mean?
Mm-hmm.
So
Yep.
it's a quarter basis point hike from the maximum that he can get. It's not a half basis point hike.
I want to see real quick where. So the 30-minute actually ended up closing above this level over here.
Mm-hmm.
Now, technically, where do you see gold going?
I see gold still dropping down here a bit more, at least in the press conference. So the thing is, if you've already entered this trade, then already, take partials or whatever, because with press conference, every question that Powell answers, the market's going to react. So I do see price continuing to push down because obviously he's going to continue the sentiment of, hey, we're still going to continue increasing interest rates. We're still on the path. I think obviously the reason why they increased interest rates is because they saw some strength in the labor market. So he's going to talk about that. He's going to talk about how they're combating inflation, which is obviously what investors want to hear. So he's going to put out all the positive sentiment that he can until like there's some sort of question where he has to answer like truthfully and be like, yeah, we're not really prepared for it. So what I'm really interested to know, and I hope someone asks him this, is what is the Fed going to do after, let's say the war and all that is over, but what is the Fed going to do if the economy is not able to handle the interest rate hikes? I think they're projecting, 6 interest rate hike, and we've been given the news about 4 at least.
Mm-hmm.
So if the Fed increases interest rates, let's say this time in May, what happens if the economy is not able to handle it? Does that mean that they're going to maintain the interest rates, or are they going to pull it back and then put in some more quantitative easing, which in turn affects the inflation and increases the inflation?
Yeah, I'd be interesting to see if we close below here.
Yeah.
Because I mean, as we were breaking down this morning, like look how nice the 4 hour looks over here.
Mm-hmm. We
Where
closed below it. That's what gave me confirmation of a sell opportunity here.
yeah,
So we closed below it, and then if you drop down to the 5 minute, we got a rejection right into that area, the blue zone. Yep, right there. And then as price started pushing down, took an entry.
so I'm wondering if we're kind of retesting this area right here.
Yeah, possibly. But the weak bullish candle closes there are still giving me a little bit of more confirmation. I mean, I've secured, but if you're looking for another entry, I would look for an entry right below that blue zone again as price, breaks the lows.
Yeah, I mean, as you can see, these are getting weaker, but you have this candle, you have the uncertainty of this candle testing the high and low over here, but it did close like a doji candle, so it kind of canceled out.
Yep.
So we'll see where we go from here. But I could see us holding this resistance and continuing down. But we'll see.
Yep.
Since we're approaching, like what, 3 hours left for New York, would this be more of a scalp than holding it for longer?
Usually with interest rates, you can hold on to these scalps that come with interest rate news and turn them into swing trades as long as price continues in your direction. But obviously for that, you need the full 4 hour daily and weekly in your direction, which we have, right? Price is still bearish on the 4 hour. We broke the previous daily low on the daily, and then the weekly, it seems like we're testing some of these key levels. Does that answer your question?
Yeah.
Perfect.
What'd you have to do today?
I'll be right back, sorry.
Now I want to pull up his actual press conference. 2:30. It's probably on YouTube, no? Yahoo. Here we go. Let's listen to the man.
Abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways, We will need to be nimble in responding to incoming data.
He's going to repeat whatever was in the monetary policy
Exactly.
statement until they start asking questions.
What is already an extraordinarily
Might as well watch it.
Yeah.
We are attentive to the risks of potential further upward pressure.
So is the volatility of every time he answers a question, that's when the press start asking questions that we'll see that?
Yeah. They'll ask him questions about different parts of the economy. How's the Fed going to handle this? How's the Fed going to handle that? What's Powell's outlook if X, Y, and Z happens? And then you'll see the volatility.
Gotcha.
Service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Let's go to Gina at the New York Times.
This is live.
Hi, Gina. Thank you so much for taking our question. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into a recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So, I guess I would start by saying that in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance.
So if you want to see real volatility, drop down to the 1 minute time frame and look at how the market's legit reacting to all the questions that
I'm
he's going to
watching
be
on my
asking.
other screen.
Yeah.
Flourish.
1 minute or even 5 minute.
Flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Thank you. Let's go to Howard.
I'm wondering how much of that do you feel is a result of the Fed's stiffer than expected action? You're talking about monetary policy operating with a lag, but is this going to bite quicker than expected?
I think that's a big piece of it, actually. I think some of that is just.
You want to bring up the volume a little bit, Stefanos?
Yeah.
Spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain, but you're looking at higher oil prices, higher commodity prices. It'll be so we think that will weigh on GDP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. We think that the potential growth rate of the economy is somewhere around 1.75%. 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come into to go faster or slower on the rate hikes. Ongoing increases doesn't really tell us whether this is going to come into.
The meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post. Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can.
What I also want you guys to kind of pay attention to as he's answering questions is look at the technical analysis. Price never breaks structure, even with him answering questions and volatility kicking in. Price is never breaking structure. Look at how price pulls back and look at the different time frames and understand how it still plays into the higher time frame structure.
At before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that in the first quarter, maybe the end of the first quarter
Come on.
this year, and and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to mean more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Let's go to Nick at the Wall Street Journal.
Nick Timmeros at the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong, as I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say, if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico. Hi, Chair Powell. So, looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know it's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Lee Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign it up in charge of that?
Sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as a result of the Fed?
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly, base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really, what we're looking for though is month-by-month inflation coming down, and so it's really it's all the things we've been talking about. that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and is back to services, including supply chains getting
Sorry guys, I don't know why I keep skipping like that.
participation, all those things that have been sticky and is the member.
Wow, that's just great. Let me check on it.
We started talking about rate increases last year. For some months now, financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now. So so the clock is running on that, and I think some of that will be seen in half of the year as well. And on the regulatory portfolio, I would just say this: we have an obligation to carry out under the law, and in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. And of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Let's go to Neil Irwin at Axios. Let's go to Neil Irwin.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the statement of economic projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 into next year. Wondered whether, and also if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil, I've never talked about my own SEP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the SEP, a good number of participants do see more than 7 rate increases this year. And I can't give you. I'm not going to try to give you a really specific test for what it would take to do that, but I will say this: that we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going. Each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Sharma, are you here?
Yep.
Awesome. I'm going to be right back, alright?
No worries. Oh, we can't hear him. Alright. I guess we'll wait for Stefanos to hop back. Does anyone have any questions so far? You guys see how the market's volatile?
We've been tracking the tick by tick as Fed Chair Jerome Powell has been providing some commentary following the Federal Open Market Committee decision, and that was to raise interest rates by 25 basis points. And we've got the Fed Chair Jerome Powell back at the podium. Let's listen.
So, despite them increasing interest rates, which I would have thought like it would have probably dropped gold a bit more. We're still just correcting to the upside.
We're reacting to whatever Powell is saying, right? So even when he was talking, we saw a little bit of a push down, and then we saw the market consolidating a little bit. And then when he started answering questions, then we started to see that push back up, according to whatever his responses were. But from a technical perspective, we're still in that downtrend, right? If anything, we're coming back into that 4-hour consolidation area, and if we break above that, then you have those clean buy opportunities. But if price retraces below, let's say 1922 area, and continues pushing down, you're still in that bearish trend. So check the 4-hour and check the daily time frame, right? Those are the higher time frames that you should be using to understand if you have a scalp or a scalp to swing. So on the 4-hour, we're coming right back into that consolidation area. Go on to the daily, and you'll see that the bottom wick that we made, there's a consolidation immediately to the left of it.
Okay, let's go to Colby Smith, BMT.
So it's a lot of liquidity grabs happening at the moment.
Right.
So that's why if you get in before news comes out, especially before press conference, always make sure to take partials, no matter you're 10 pips in, 20 pips in, or like 100 pips in. Always take partials and move to break even.
What I miss?
Kat was just asking questions about the push up. Like, is it? And I was telling her that it's from a technical and a fundamental way. So technical is we saw the push down when interest rates and all that came out. Even a little bit of a further push down when Powell started talking a little bit. And then when he started answering questions, we saw the reaction as prices pushing back up. You know, the price reacting to whatever he's saying. But right now, if you go onto the 4-hour time frame, we're coming back into that consolidation area that we were in this morning, right? Where price generated all that liquidity and everything. We broke the lows, right, on the 4-hour too, but we're coming back and we're tapping into that consolidation area. Now, if you go onto the daily time frame, then you'll see that even the bottom wick that we made on the daily, right next to that is all that consolidation, right to the left of it. And that's where price is also grabbing liquidity. So if you're ever in a trade, especially with interest rates, before press conference comes out, regardless of like how many pips you may be in profit, it could be 5 pips, right? It doesn't really matter. But make sure you take partials, move to break even, and be completely risk-free in a trade. Because this is the type of volatility that you will see as Powell answers questions.
Been looking at GJ over here too.
Yeah, GJ is pushing up. I'm still in it. Are you?
No, I actually closed this morning, but
Okay.
I was looking to take another entry as this candle flip bullish over here.
Yeah.
What is this? The 15-minute? Yeah. So the 1 hour is about to close in 4 minutes. So we'll see. If you look at the 1 hour right now, you should be getting a bottom wick on the 1 hour somewhere into here, and then you could possibly take a trade right over there to take this right back up to 156.
Yep.
If you take a look now at like the 5-minute, we're retesting this area over here.
I extended my TP to 157, but we need to break 156 first because that's a yearly, quarterly, monthly, weekly, daily, 4-hour, all of that resistance.
Absolutely. So we could definitely be coming back into this area over here before heading back up on GJ.
First of all, there is no looking at medians, but understand that there's no, it's not something we voted on, it's not a plan. But if you look, people do have their by the end of this year, broadly people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing, that should, in other words, that should be a removal of a combination for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does this number remain at 3.5%? I mean, a couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this there are many, many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is its tools to make sure that higher inflation does not become entrenched. So we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Sometimes you'll see crazy amount like 100 or more pips.
Where during the press conference?
Yeah,
Yeah, I've seen that happen before.
yeah. Because right now, look at ever since Powell started talking, in the last like two 15-minute candles, right? We're already like 100 and what's that? 100, almost 170 pips, right back into consolidation.
Yep. Got 1 minute for the 1 hour to close.
Well,
Oh, for
Does
GJ,
it close? Does it close back into this range?
yeah, for GJ, usually it's around like it's not as crazy like 100 pips.
every unemployed person. So that's
So I'm looking to see. It's a strong 1 hour candle. This tells me that we're heading right up to 156.
Yep.
There we go.
Let's say that our tools work about as you described. And the idea is we're trying to better align demand and supply, let's just say in the labor market. So it would actually, if you were just moving down the number of job openings so that they were more like 1 to 1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people, that are having a hard time hiring. So that's really the thinking here. Is these are fairly well understood channels, interest sensitive, and basically across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again, we don't have a perfect crystal ball about the future, and prepared to use our tools as needed to restore price stability. As I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
Okay, let's go to Scott Horsley at NPR.
This covers some of the same ground you just talked about, Mr. Chair. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the primary workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce, and what would that mean for wages and inflation?
Anyone else hear that?
It's hard to say. What we saw in the last cycle was that over the course of a long, steady
Oh wow, I didn't even see the chat. Sorry guys.
outperformed.
Yeah, I got my TP around one.
And
Okay.
that was just
Here's like over the next few days, just like that's
nowhere near as tight as this market, but it's a tight labor market, and so people stayed in the
He
labor
was-
force longer. It wasn't so
he was saying is are people going to be ending up following Tom Brady out of retirement and coming back to the workforce?
And,
Pretty good one.
participation is tremendously welcome, and of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate.
So I would just look at Kat was saying I would just look at getting in GJ when you see your setup. Like you have a trade like this. If you're gonna take it off the 1 hour, what is your stop loss gonna be all the way down here? It looks like we found a small wick over here on the 1 hour, and we're passing the high of this candle. So where can you get an entry up here if you're comfortable doing so? It looks like we found a nice support over here. Price has a wick to fill, right? Are we creating that bottom wick over here, filling that candle, and continuing up to 156? right? So, and I think we could very well continue. Or did we just increase rates in the U.S.? Now GJ is kind of pricing in that rate hike right now, and then we don't move that much tomorrow. Does that make
That's
sense?
that's exactly what's happening right now,
Yeah.
because it's kind of bringing the strength back into risk currencies. But if I'm looking for a scalp and then trying to turn that into a swing trade going into interest rates tomorrow, I would hop up to the daily real quick if you can.
On GJ.
Yeah. All right, perfect. So what I want to take a look at is how price is reacting right into this area of 156, right? And then actually let's start off on the weekly. I think that's going to be better. Yeah, there we go. So on the weekly, I want to see how price is reacting right into this 156 level. If we can continue pushing bullish from here, and maybe like obviously, wait for some retracements and stuff, maybe going into Asian and whatnot, like expect price to react off of this, right? And then if price continues pushing up, I want to see some form of break and retest being formed around this area. So it could be legit, right underneath the zone here, or it could be right above it. Doesn't matter, as long as it's somewhere close to the zone, showing us that we have volume pushing up. And then I'd be looking for those buy opportunities going up into 157. If you've already gotten into a trade from like this morning, that the one that we called out, if you're still in that, then just hold on to it and then take out partials. Make sure you're trailing your stop loss, not moving to break even, but more like trailing it because of the volatility. And then let runners go up to 157 or even 158 area. But I would say 157 given that price has reacted off of this multiple times. So I would use the weekly and daily for that confirmation.
100%. Yep. Daily. I mean, these are strong bullish candles. But what did we say before, Kat? You buy the rumor, sell the facts. So, or buy the rumor, sell the news. So, that's what I really see happening right now. Like we're right back up to 156. We're at 153 not too long ago. And we are at 151 not too long ago.
Yep.
We just pushing up from that level.
It's all market sentiment, and then technical analysis is your visual representation of that market sentiment.
Great point. Where are we?
Real economy, and it does so through financial conditions, which means as we tighten policy, we'll see more accommodations so that it's less accommodative. And our financial conditions will also
Thank you. Just a little housekeeping note. Those of you in this call may be having some tech issues. If so, I understand the broadcast is coming through clearly on www.federalreserve.gov. You might go there for the audio. And now we'll go to Gene Young. Hi, Chair Powell. I wanted to ask about the balance sheet discussion you had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what appears if there were any details?
Yes, thank you for asking. So in our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning around at a coming meeting, and that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that that's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context. We'll make the decision on timing, and we always want to use our tools to support macroeconomic conditions, avoiding adding uncertainty with a highly uncertain situation. So all of that will go into timing. In terms of we're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this. But it'll be faster than the last time, and of course it's much sooner in a cycle than last time. But it will look familiar to you, and I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that we'll lay out, pretty much the parameters of what we're looking at, which I think will look quite familiar.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run the hot and bring unemployment down. That seems to be over, but I'm wondering how you would describe the reaction function now. What is it that the Fed is trying to do other than bring inflation down? In other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah, so I want to clear one thing up again, and that is that in our new
Hi.
I just wanted to share you out because I'm doing it.
To raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said, and that was the sense of it. There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework. In fact, quite the contrary. The framework is all about anchoring inflation expectations at 2%. So I do hear this, that the framework, really, we can't blame the framework. It was a sudden, unexpected burst of inflation, and then it was the reaction to it, and it was what it was. It was not in any way caused or related.
Stefanos, you want to go over what to expect for the rest of the session real quick before?
Sure. Let's want to pause him?
Yeah.
Okay, cool.
So you guys can continue watching that, but for the good part, for a majority of the part, you guys know how the market's reacting to whatever Powell is saying, and the good, bad, all of that, the volatility. So you guys are seeing firsthand how the fundamentals are coming out, what the market sentiment is, and how is that being related to the technical analysis, right? So now for the rest of the session, what you guys want to take a look at is some of these higher time frame levels. We just talked about 4-hour, daily, weekly. We talked about how to turn like a scalp into a swing. For GJ, you're going to do the same exact thing for gold. So pay attention to what's happening to gold, for example, on the 4-hour time frame. What just happened here, right? You had price push up, reject right into that consolidation area, right? And then you had a massive bottom wick rejection. This is not confirmed as a liquidity grab until this candle closes bullish, right? So what you want to see end up happening here, if you're going to look for any continued sells, is a clear resistance being made. Should not be breaking 1922 if it's going to continue pushing down. There's no reason from a technical perspective, right? It could come back, it could fluctuate here, which is completely fine. That just tells us that the market priced in the interest rates here. And then we have press conference questions coming out, and all that consolidation is obviously showing us uncertainty. And then tomorrow this week we have JPY interest rates coming out. Is it today, Asian session, or is it tomorrow? If you could check Forex Factory real quick.
Yeah.
So that, and then you also have Bank of England's interest rates coming out. So we have 3 major bank interest rates coming out. It's an Asian session. So tomorrow, I think. Scroll down a bit more.
Share orders.
Yeah, it's tomorrow.
Tomorrow, Asian.
Policy
there you
rate, right?
Monetary policy.
Yeah, so you have 3 major bank interest rates coming out this week. And so we already know that Bank of Japan said that they're going to maintain their interest rates, are going to maintain their accommodative policy stance. And then we have Bank of England that's talking about increasing interest rates, right? So clearly that means that we're getting, from just the interest rate fundamental, we're getting more optimism and more strength into risk currencies and risky assets compared to safe haven commodities and currencies. So that's something that you want to pay attention to, right? And then also take a look at those higher time frame structures on both pairs. So if price breaks above 1922 on gold, then you have those potential buy opportunities. If price continues pushing down and you want to watch for 1912 area, 1910 area, and then price pushes down from there, that's when you start looking for those sells. So what you need to see happening here, clearly, if you're looking for any sort of sell opportunities, is a candle coming back and closing below 1910. I'm going to annotate here real quick, Stefanos.
Sure.
So closing below this, and then some sort of a top wick rejection, and price continue to push down. As that happens, your sell opportunities are going to be right into this zone as price is breaking down, right? And then you could come back and target some of these wick fills. If price is not breaking below, closing below these areas, if it's just wick rejection or anything like that, it's not really breaking lows, you do not have a sell opportunity, right? So you want to make sure that you're giving price enough time to consolidate, collect orders, do all the stuff that it needs to do before looking for any sort of sells. Do not trade in a consolidation. Right now is not the time to do it.
Yep.
Same for GJ, we already discussed it.
Yeah, GJ, yeah, 100%. We're heading right up to 156. Looks like we're kind of fluctuating over here. I was wondering if we're going to stall out
Yeah.
and then create like a deeper bottom wick and then continue up, but this is a very strong candle right here. So, nice little retest, higher low formed, strong candle with a wick to fill, and it looks like we're kind of just heading up right now.
Yeah, so even for this, if you go on to the 4 hour, we've had a nice bullish push up ever since price made that consolidation in 154 200. So the last 3-4 hour candles, we have been pushing up with a ton of volume. Look to the left, and that 156 area is your area of consolidation from the daily and from the 4 hour. So clearly price is going to react to that, right? So first you need to break 156, only then can you head up to 157. So if you hit 156, take partials and secure, or go to break even, trailer, stop loss, whatever you got to do. Make sure that that's still a winning trade, and then let your runners go up to 157.
Now, KB, did you get into that GJ buy this morning?
I did, yeah.
Okay, perfect. Now that would be a perfect opportunity for you to have that second entry that we were talking about this morning, to take this thing up and just let it run the rest of the day, because you would have been up. Let's say you risked 0.5% on this, you would have been at least up maybe 3-4%, maybe, if you just let that run. Does that make sense?
Yep.
So it's just something to incorporate and start incorporating it into your backtesting, and you'll see that there's a couple opportunities that you can just leave going. Especially if you do like a full week review on your pair, you're gonna see there's a couple opportunities throughout a week, especially a high volume week that or a trending week that you could grab that.
Definitely.
For the hang of these swings. Yeah, a little bit. No, I'm still working on it myself. I'm a scalper at heart, and I'm comfortable taking my pips and getting out of the market. So that's another level that I've been working at reaching is being able to leave those positions running. And the key to doing that is going risk free and just leaving the chart. Don't even look at it.
Yep.
Takes all the emotion out of it.
That's why you got to keep yourself busy, right? So then you're not tempted to stay on the charts all the time. Like I spend 2 hours maybe every day on the charts. 1 hour in New York session when I'm like live trading, and then we're here on YouTube with you guys. That's probably the longest time that I spend in New York session, because I start earlier here with you guys than I would like any other normal day. You could ask anybody. We start around like 5 a.m. PST, which is 8 a.m. East Coast, right when the market opens up, right? Yep. For YouTube, we start like an hour earlier. That's the longest time that I spend. And then 1 hour in Asian session just for the trade breakdown. That's it. So you got to keep yourself busy so you're not tempted to come back onto the charts. And that's the whole point of trading, to give you the time freedom that you want instead of becoming a slave to the charts.
It's where owning businesses come in. They'll keep you busy.
Absolutely. My mom still makes fun of it. She is like, you would really just be starting a new one every time, and then just like growing it and then delegating task and everything. I'm like, yeah, well, that's how it's supposed to be.
Exactly. It's a hobby.
Yep. Absolutely.
All right, guys. Well, you guys have a great day. It was nice hopping on the charts with you for the second time today.
Yep.
And my group, I'll see you guys bright and early tomorrow morning.
All right. Awesome. See you guys.
All right, guys. Have a great day, all right?
Bye-bye.
Thanks, guys.